Welcome to the Deep Dive. Today we're tackling something pretty mind-bending, actually. A concept that could genuinely flip our understanding of markets on its head. The inverse short squeeze in Bitcoin. Some people are calling it the big long. We got a whole stack of material here, financial reports, market analyses, deep dives into Bitcoin itself. And our mission today is to really understand mechanics, How could this actually happen? What does it mean for Wall Street? And maybe even more importantly, what does it mean for you?
Yeah, it's a fascinating topic, and it starts with something people think they know, which is shorting. You hear shorting, you immediately think, okay, someone's betting big that a price is going to crash. Speculation,
right?
Often negative.
Right, like betting against a company, hoping it fails. Yeah, that's the common picture.
Exactly. But what gets missed, especially in these big, sophisticated derivatives markets, is that shorting is also absolutely vital for something else. Risk management. It's not always about speculation. Sometimes it's just insurance.
Okay, insurance. That sounds less dramatic.
Yeah.
So it's about protecting what you already have, not just betting on a fall. Can you give us an example maybe with Bitcoin?
Sure, absolutely. Let's picture someone, maybe a high net worth individual, who got into Bitcoin way back. Say they bought a load at $10,000. Now maybe that position is worth, I don't know, $1 billion. Huge gains.
Wow. Okay, so they're sitting pretty, but maybe a bit nervous.
Exactly. They're sitting on this massive gain, but maybe they don't want to sell. Why? Well, taxes for one. Selling triggers a huge tax event. So they want to protect against a big drop, get some insurance, but without selling the actual Bitcoin.
Right. Keep the upside, limit the downside, avoid the tax hit.
Makes sense.
But how do they do that?
They go to a big derivatives desk, let's say, hypothetically, Goldman Sachs, and they say, I want to buy puts. A put option gives them the right, not the obligation, importantly, to sell their Bitcoin at a set price, say $60,000, even if the market price crashes below that. It's their safety net.
Okay, so they buy this insurance policy from Goldman, but now Goldman's on the hook, right? If Bitcoin crashes, they lose money on that deal.
Precisely. Goldman has just taken on a massive amount of potential downside risk. So what do they have to do? They have to hedge. To neutralize their own risk from selling that put, they must get short exposure to Bitcoin. They might borrow Bitcoin and sell it, or use futures contracts.
I see. So Goldman isn't shorting because they think Bitcoin's doomed. They're shorting simply to balance their books from selling that insurance product.
Exactly right. It's purely mechanical. It's risk management 101 for them. Think about people like Jamie Dimon, right? Even if they express skepticism about crypto, they call themselves risk managers first. This kind of shorting, driven by hedging, has absolutely nothing to do with negative sentiment. It's just how mature markets function. It actually helps the market, enabling this kind of risk transfer.
That's a really critical distinction. Yeah. Because it implies there's this huge amount of shorting happening that isn't about betting against Bitcoin at all. Okay, so let's take that idea, this necessary mechanical shorting, and collide it with what makes Bitcoin. Well, Bitcoin. It's scarcity.
Yeah, and this is where things get potentially explosive, because Wall Street has literally never dealt with an asset quite like this. Think about what they're used to. U.S. Treasuries, the government can always print more if needed. Supply is flexible.
Okay. What about gold? That's seen as scarce.
It is, but gold has its own quirks. First, you can rehypothecate it. That means the same physical bar of gold can back multiple paper claims. You can lend it out, then the claim gets lent out, and so on. Creates way more paper gold than physical gold. Plus, miners dig up new gold every single year. The supply does increase, albeit slowly.
Right, so paper claims can multiply, and new physical supply comes online. What about stocks, like GameStop?
Good example. GameStop was squeezed hard. But what could the company do? It could issue more shares, and you did. Selling new stock diluted the existing shares and, crucially, provided more shares for the shorts to buy back to cover their positions. It was a release valve. Companies like MicroStrategy even manage this proactively, selling stock sometimes just to make sure there's enough borrow available for the options market. There's a CEO, a board, they can act.
But Bitcoin.
Yeah.
No CEO, no board, no printing press.
That is the absolute key difference. 21 million Bitcoin, ever. Full stop. And estimates suggest maybe 4, 5, even 6 million are already lost forever. Gone. Forgotten passwords, broken hard drives. So the actual circulating supply is even smaller.
Okay, fixed, even shrinking supply. Now, contrast that with what's happening in the derivatives market for Bitcoin. It's been growing like crazy, hasn't it?
Exploding is probably the right word. You've got the big institutional products now, like the spot Bitcoin ETFs, IBIT, others. They're bringing in huge amounts of capital. Then look at the established exchanges. The CME, the Chicago Mercantile Exchange, reports something like $15 billion in Bitcoin futures short interest. Binance, the big global exchange, maybe $13 billion short via perpetual futures.
So just on those regulated, visible platforms, we're talking tens of billions in short interest. But that's not everything, is it? What about the less visible stuff, the OTC market?
Exactly. That's the tip of the iceberg. Over-the-counter OTC transactions are private deals between two big parties. They don't show up on public exchange order books. Based on, talking to people in the space, analyzing flows, my personal estimate is that the total Bitcoin short interest, including all that OTC hedging, could be anywhere from $300 billion, maybe even up to $500 billion.
For $300 to $500 billion, that's staggering. And you're saying most of that isn't people betting against Bitcoin?
That's the crucial point. Of that massive number, maybe only a tiny fraction, perhaps $1 billion, is actual speculative price goes down betting. The rest, that $299 billion, maybe $499 billion or more, that's almost entirely risk management. Hedging. These are institutions, maybe even the H&W individual we talked about, who probably want Bitcoin to go up, but they need to hedge their exposure for regulatory reasons, for client mandates, for balance sheet stability.
So you've got this enormous, largely hidden mountain of short positions, mostly for hedging, built on top of an asset whose supply is absolutely fixed and can't be increased.
Precisely. Wall Street has built this massive derivatives complex, business as usual, assuming the underlying asset behaves like other assets they know, but it doesn't. It's unprecedented.
Okay, the stage is set. Massive required short exposure, fixed unprintable supply. How does this potential big long, this inverse squeeze, actually unfold? What's the trigger?
It boils down to Bitcoin being a bearer asset. This is fundamental. Unlike owning a stock where your broker holds it and you own a claim, with Bitcoin, you can hold the actual keys yourself, like holding physical cash or a gold coin in your hand.
You mean taking it off exchanges, putting it into self-custody? Hardware wallets, that kind of thing?
Exactly. Cold storage, hardware wallets, even just securing your seed phrase properly. When you do that, you physically remove your Bitcoin from the financial system's plumbing. And critically, that Bitcoin is no longer available in the pool that institutions borrow from to establish those short hedges.
And we are seeing a trend towards that, right? People like Michael Saylor, Jack Mallers, Grant Cardone, they're very public about holding their own keys, telling others to do the same.
Absolutely. And every time someone takes their Bitcoin into self-custody, whether it's a big whale or lots of smaller holders, it shrinks that pool of lendable Bitcoin. So what happens next? As that pool shrinks, Bitcoin becomes hard to borrow. The interest rate to borrow, it spikes.
Like supply and demand for borrowing. Less supply, higher cost.
Right. Eventually, it might become almost impossible to borrow Bitcoin at any reasonable rate. And that's when the panic can start. Those institutions holding massive short hedges start getting nervous. They need to maintain those shorts to cover their derivative positions, but they can't find Bitcoin to borrow, or the cost is astronomical. So they're forced to go into the open market and buy Bitcoin to close out their short positions.
A forced covering.
Yeah.
But we saw that with GameStop, didn't we? What makes this potentially so different, or, as the source material suggests, much worse?
Several things make it different and potentially much worse. First, like we said, GameStop could issue more shares. There was a release valve, a source of new supply. Bitcoin has none, zero. Second, with GameStop, some platforms controversially restricted buying, which dampened the squeeze pressure. You can't just turn off the buy button for a global decentralized network like Bitcoin.
Okay, no new supply, can't easily stop the buying.
What else? Valuation. This is maybe the most critical difference. With GameStop, even when the price went crazy, you could still point to company fundamentals, sales, assets, earnings, or lack thereof, and say, okay, this price is objectively nuts. There was some kind of anchor, however tenuous. With Bitcoin, there are no earnings reports, no PE ratios, no factories or inventory. If Bitcoin hits $1 million tomorrow, it's just a number reflecting supply and demand at that moment. There's no objective, universally agreed upon valuation metric that says this is too high. The price is simply what the marginal buyer is forced to pay in a panic, chasing a dwindling supply.
Wow. So the price could theoretically just keep going up and up because the buyers have to buy, and there's no fundamental reason to say it should stop at any particular point.
That's the potential dynamic, yes. A forced buying frenzy with no natural ceiling based on traditional metrics.
Okay, that sounds destabilizing, to say the least. If this scenario plays out, what are the wider consequences? We're not just talking about some hedge funds going bust, are we? What about the whole system?
The systemic risk is significant. It really centers on counterparty risk. The financial system is this incredibly complex web of interconnected obligations, derivatives, loans, repos. Everyone owes everyone else something. If a major institution or several holding massive Bitcoin short hedges suddenly faces catastrophic
like Lehman Brothers in 2008, but potentially triggered by Bitcoin.
That's the fear. A default by one major player could trigger a cascade. Their failure means they don't pay institution B, which then gets into trouble and can't pay institution C, and so on. Given the global nature of these markets and the potential size of this opaque OTC short interest, you could be looking at, the potential for multiple major bank failures globally. Think Deutsche Bank, UBS, Zargan institutions heavily involved in derivatives.
Multiple major bank failures triggered by a run on scarce Bitcoin.
Yeah, it's been described as potentially like a bank run on steroids, but with a twist. In a normal bank run, people pull cash out, the government often prints more money to backstop things, and that cash potentially loses value through inflation. Here, as people pull Bitcoin out into self-custody, making the asset scarcer for the institutions that need it, its price could actually go up dramatically. The asset being run on becomes more valuable, not less.
So the act of securing your asset makes the crisis worse for those short and increases the value of your holding. What about the broader economy if Bitcoin's price goes parabolic?
Well, a sudden, massive surge in Bitcoin's price could create trillions of dollars in new wealth almost overnight for those holding it. If even a fraction of that new wealth starts flowing into the real economy, buying houses, cars, goods, services, it could absolutely pour fuel on inflation, making everyday goods more expensive for everyone else holding traditional currency.
This sounds incredibly risky, especially, as you mentioned, the lack of transparency. We don't really know who holds what or how much actual Bitcoin backs up the claims in the system, right? Like with big custodians.
That's a huge piece of this puzzle, yes. Many large custodians or exchanges that hold Bitcoin on behalf of clients don't provide real-time, publicly verifiable proof of reserves. So regulators and even other institutions don't have full visibility. Do they actually have all the Bitcoin they say they do? This opacity adds another layer of systemic risk. It creates, a real pickle for the entire global financial system.
A pickle indeed. But you also mentioned that Bitcoin itself might offer a solution. How does that work?
It's the inherent nature of the technology itself. Bitcoin runs on a blockchain, which is fundamentally a public, distributed, auditable ledger. While individual identities are pseudonymous, the transactions and holdings on the ledger itself can be verified by anyone. This offers a stark contrast to the opaque, siloed ledgers of the traditional financial system that made crises like 2008 so hard to untangle. Bitcoin's design is transparency.
So the very thing causing the potential crisis, this unique digital asset, also contains the seeds of a more transparent financial future.
That's the argument, yes. Imagine a system where major institutions could provide cryptographic proof of their reserves, verifiable by anyone on the blockchain, say, every 10 minutes when a new block is mined. That radical transparency could prevent the kind of hidden leverage and counterparty risk buildup that we see today.
Okay, so wrapping this all up for our listeners, what does this really mean for you? We've gone through these complex mechanics: hedging, scarcity, derivatives, self-custody. This inverse big short, or the big long, isn't just some wild theory. It seems like a plausible, maybe even inevitable consequence of Wall Street's existing plumbing meeting Bitcoin's unique, unchangeable rules. It raises a huge question. If the problem is a lack of transparency, and Bitcoin's core design is transparency, what kind of world emerges if this financial reordering actually happens? Could we end up in a place where, as some suggest, citizens can effectively verify the claims of governments and financial giants, demanding a whole new level of integrity?
That's the potential long-term vision for some. The transition, as the analysis suggests, could be very painful for the existing system, but for an individual. The takeaway seems to be that holding Bitcoin, especially in self-custody where you control the keys, might be the ultimate safety measure, an off-ramp from this potential systemic turmoil.
True ownership, an asset that, in theory, can't be diluted, seized, or manipulated by the traditional system in the same way other assets can. Something to really think about. What does it mean to hold something like that in the face of potentially seismic financial shifts? That's all the time we have for this deep dive. Thanks for joining us.